and welcome Frank Days to the Ticker studio. Frank, welcome to Ticker Property.
Thanks for having me, Chris.
Frank, tell us about your business.
So my business is effectively a project management business that looks after the Class 1B space.
What's a Class 1B?
Yeah, great question, Chris. It's one of those things that we use. Class 1B is actually the legal terminology from the Building Association, but there's a lot of names out there for it. It could be called co-living, it could be called new generation boarding houses. We have all these fancy names for it, micro apartment studios, but the reality is what they are is rooming houses or boarding houses, which is terminology we don't like to use too often because it has a stigma attached with it. But the way we do it is we don't slice and dice old properties. That's the old style of doing things. We actually build them from ground up. So each particular space is self-contained. Each room will have its own ensuite, its own heating, cooling system, kitchenette, and then there'll be a communal area.
So how many people would live in these rooming houses as such? And are you also building it to spec based on the number of people?
So there are some regulations we have to adhere to fall under that Class 1B regulations. If you go outside of those regulations, you become a Class 2 building or Class 3 building, and that's when you have to start going through town planning and getting permissions and bits and pieces. So the rules and regs around it are it can't be any larger than 300 square metres. You can only have 9 self-contained rooms and 1 communal area and a laundry, and you can't ever have more than 12 people staying in that particular property.
Is there a demand in the student housing space to do things like this? So if you've got 9 rooms and a common area, would you typically see these developments or such come into where universities are located?
Look, we have built several near hospitals, near universities, thinking that we're going to get a lot of nurses in or trainee doctors, or we're going to get 100% students in there. But the reality is that's not always the way it works out. So the studies I've done is between my builders, we've done over 100 of these across Melbourne. The ones that we've built close to universities, there's only 3 that I know of that are 100% university students, and that's specifically because that owner has contacts internationally and he derives his income from those students coming in and staying for the year. But typically the demographics can be a cross-section of society. We've got vets, we've got doctors, procurement officers, tradies, real estate agents, you name it. That's the sort of tenants we're attracting at the moment in the space.
And is it a shell? So when you talked about development, are you taking a shell and then redoing the fit out to be able to?
No, we start from scratch. So what we do is we'll identify a site for our clients that is suitable. They'll then purchase that site either with or without my assistance.
And you're talking knockdown rebuilds? Or
correct, yeah. So we want to build in brownfield zones. We don't greenfield. It's
too far away?
Well, it doesn't have that mass of population that you really need for these to work. And sometimes the infrastructure's not there either. So, something that's an established neighbourhood, you buy the worst house in the street, you knock it over and then you build one of ours.
And typically is it 3 or 4 levels?
2 stories is maximum. We will put as many rooms as we can on the ground level. So if you've got a large site, we might do everything on ground level. Simply because the ground level units will have, or studios will have, its own courtyard area, not having continuous stairs, whatnot. And some of the growing demographics around the space are the over 55s, who are finding themselves either wanting to downsize, they're divorced, they may be widowed, and they're finding these sort of opportunities perfect for them in terms of being able to save cash flow.
As an investor, how does it differ to a traditional property that you buy on either a greenfields or a typical investment property?
Huge. So if we take a standard residential property in Heidelberg Heights, 3-bedroom house, it might be returning $450, $500 a week. If we replace it with one of our builds, they'll be looking at somewhere around $3,000 a week coming in.
Why the significant increase?
We have 9 streams of income. So each room is going to rent in that particular area for around $340, $350 per room. Now that is what we call suitcase ready. So it'll be furnished, the water, the power, the internet will be supplied. Makes it very easy for the tenants just to be able to walk in there, create their home. The tenancies tend to be sort of 6, 12, 18 months, and they're set for life. The only thing they have to worry about is paying their phone bill, petrol for the car if they've got a car, and everything else is looked after for them.
And all the expenses that you mentioned earlier, is that consolidated into one bill?
It is, yes. So again, just for simplicity, they pay the one-off $350 per week or monthly, however they do it, and they don't have to worry about anything else.
When you talked about the rental return on a $450 a week versus $3,000, the capital outlays, for example, Heidelberg Heights, you're talking about what, $1.3 million for the capital instead of the ejection. What would be the offset to get a return of $3,000?
So what we'd be looking at is a site that, looking at some sites during the week, last week and over the weekend, we could have picked something up for about $650 in some cases, just outside of Heidelberg Heights. That would be suitable, and then the build cost itself, turnkey, you're looking at about $700, $720, depending on certain aspects.
So about 1.4, 1.3 to get up and firing and ready to make some money.
Correct, yeah. And it's about a 2-3 month lead in to do the design work, soil tests, everything else we need to do, remove the current property, and then once we start building, it's about a 6-month term to get that up and running before we start getting the tenants in.
And is it a one-to-one relationship from an investment perspective, or are we talking a group or a syndicate of investors who come in and put in?
That's a really good question. So typically, to this point, I've been working with mum and dad investors on a one-to-one basis. So they've been in a position where they're financially secure, they have the capacity to go and borrow the money to get these up and running, because they're not cheap to get off the ground. And typically you're looking at a commercial loan, so the LVR might be something like 60-65%. So there's a big chunk of cash needed to be injected to get these off the ground.
And why is it a commercial loan as opposed to a residential loan, being that it is a residential zone?
Yeah, the banks, to this point, so over the last 2 years, the biggest issue I've had is around getting finance for these, because the banks look at them and they don't know, is it a house, is it a commercial unit? They really can't get their heads around it. And worst case scenarios, they actually take that particular file and put it to the bottom because it's just too hard. So we found if we go down the commercial route, it's just simpler. It is getting easier. There's a little bit more acceptance of this type of product, and of course all the chatter out there about affordable housing, this product provides that. So it looks good on the bank's books if they can get these in there. I had some very good conversations with NAB 2 weeks ago. They've committed $2 billion towards affordable housing, and these fit into that criteria. It's just a matter of, do the particular lendees fit that criteria? I'm
intrigued about the $3,000 a week average return per week. Are you making money on a margin on those expenses as well? How do you get from 450 to 3,000 at high level?
So effectively, each room, let's assume we didn't provide the services, you'll be looking at about $290 per room. So the extra $40, $50, $60 is to cover off the power, the water, the internet. But even if we didn't supply those, you're still looking at a very high return. The reason we recommend our clients offer those services, it is more appealing to the tenants to get them in. They just find it so easy. In terms of the returns, and it's one of those things that when I came across this product 2 years ago, and if we go back to the stigma attached, I was approached by a headhunter and says, look, Frank, you're entrepreneurial, and of course that gets you going, of course I am. Have a look at these Class 1Bs. And I said, well, what's a Class 1B? And they said, just have a look. I said, no, tell me what a Class 1B is. And they said, oh, it's rooming house. I went, nah, not interested. Yep. They said, no, you really need to have a look at what these guys are doing in the space. You wouldn't know it's a Class 1B from the street. You go into them, they're beautiful, they're well maintained. So I went and had a look, and I went, what have I been doing for the last 30 years in property? I should have been on these years ago. And once you get over that stigma, and then you start looking at the opportunities, I had Domain do a feature on these, and part of that requirement was they needed to speak to some of the tenants. And they interviewed this chap. He'd just moved into one in Frankston, 70 years old. His wife had passed away. He sold the family home, moved into one of these to be closer to his grandchildren, And when Domain asked him, well, how do you feel about living in a rooming house? He says, what are you talking about? I'm in my own apartment here. And that's what we like to create, that real feel of home. It's self-contained, but there's still a community around you. Yes. The important part about the whole process is having the right property managers on board, so that they're doing the right vetting to get the right people into that space as well.
And you would typically have one property manager looking after the whole site?
Yes. So it is one property. So Class 1A is a standard residential house that you or I might live in. Class 1B are these. The beautiful part about that is because our Class 1, no town planning requirements at all. You have as of right to build, you just need a building permit.
Yep. So that's what I was going to touch on next, is in terms of regulations and town planning. Could you touch on that based on the 1B?
Yeah, certainly. So as I mentioned earlier, there are some requirements that you have to meet. And if you go outside of those requirements, you may be asked to remedy it by either tearing it down and starting again, or going to the next class level, which may require you putting in sprinkler systems, more car spaces, etc. So it's very important that you get it right. But the main regulations are 300 square metres of floor space, no more. So we typically do 299. Can only have 9 lettable rooms maximum. Must have 1 common area and a laundry, and must have 3 car spaces, one of which is set up for a disabled, and one of the rooms also has to be set up for disabled purposes. Those are the key. And also, probably the last key part of that is you can't have more than 12 people living in the property at any one time.
What type of clientele, you mentioned earlier the type of people, who are you targeting and where areas are you going for in terms of putting these 1Bs up?
In terms of the investors, so to date it's been primarily mum and dad investors who have the capacity to get the loans for these properties. Recently I've been talking to more sophisticated investors, so we are dealing with 2 different fund managers at the moment who are doing these at scale, and we have another developer who's about to come on board, and he's going to inject about 20 million into the market to build these. In terms of area, as long as it meets all the criteria of any normal investment property. So you want to be near public transport, you want to be near shopping, you want to be near doctors' facilities. Schools obviously aren't as important unless they're tertiary, but you tick those boxes, you're pretty much right to go.
All right, well, let's take a short break, Frank. When we return on the other side, we'll continue our chat with Frank, and in particular, what type of returns the investor can expect over the long term. Welcome back to Ticker Property, thanks to Moving Hub. Let's further our chat now with Frank about this unique investment property approach that has got me intrigued. Frank, what type of returns longer term? We've talked about the short term return. What longer term return does an investor get?
So with this particular asset, you're looking at, and the main variable is the land component. So assuming that we get that part of the puzzle right, we're looking at between 7.5% and 10% net yield, which can relate to maybe 11 or 12% gross. That's on the ongoing basis. When it comes to what that particular property is going to be worth in 5 or 10 years, it's going to depend on a couple of variables. So in the first instance, we'd probably look at what the cap rate is. So if we're looking at a 6.5 to 7.5% cap rate on the 1.4 million one we just discussed, that in a year's time will probably value up to about 1.9. And as the rents go up, that cap rate will change.
Are you then refinancing on those, or are your clients using those assets which have increased over the years to then purchase more products? Are your investors coming back
so
for more?
Typically if they buy one, they'll buy multiple. So getting across that threshold of that stigma that we talked about earlier, once they get past that and then they start looking at the numbers, then they start thinking, oh, that's too good to be true. Once they actually get involved in it, they build the first one, we'll see them come back for second, third. We have one accountant who's built 6 of these, which he'll be retiring on any day now. So yeah, absolutely, the capacity to draw down capital out of these or equity is potentials.
And in terms of the whole process, you've obviously found the property. Is it a kind of a joint venture type partnership with the investor to say, well, your role is to go and source the property and put your IP together, and for the investor to bring in cash, and then are you going like a 60-40 relationship, or is the whole asset owned by the investor?
100% by the investor at this stage. So typically they will either get a line of credit or a mortgage, and typically to fund it. Then once it's built and been up and running for 6 months to a year, then they'll get it revalued, and then they have the asset capacity to pull down some more money or equity out of that and do whatever they want to do next. But it's 100% theirs. We have no interest in those ventures. But given the fact that it is quite difficult to finance, we've been researching ways that we can help people get into these. I've had discussions with Domicom, and as of last week, we've agreed on terms that was going to see us be able to enter the market with Domicom with these assets, where investors who don't have the capacity to do one of these on their own will be able to buy a fraction. It's called fractional investing of one of these properties. So it's effectively a syndicate of people who either do or don't know each other. It's like buying shares. You don't need to know the other investors in that particular product. They'll be able to enter the market that way and benefit from the returns.
Does that mean the platform can get two investors who potentially know each other and say, well, let's go half each of $600,000 each and do it together? Is that the platform you're going to create?
You can, and if you had two, I'd probably not worry about going to the platform, particularly if they know each other. You'll just want to see your financial planner organise a trust that you both put your funds into. The Domicom platform is going to allow us to do multiple investors. They start from a $2,500 investment. We'll probably be looking at $25,000 because we don't want too many fingers in the pie, if you like. Just to simplify things, we'll have an end date. So 5 years down the track is when we'll review, do we sell, do we keep? The thing with these assets is no one sells them. So, and all the ones I've been involved in, no one's ever sold one. So it's really hard to have
the conversation because the income is so high each week, each
Correct,
month.
Yeah. So once they see that coming in, it's like, no, we're going to hold this.
And who makes the call? Does the investor go, well, they might want to knock it down and the property's now worth $10 million when it was purchased for $1 million? Who makes that call to knock it down and go through the process? Is it you or is it them that make the call?
Absolutely the clients. And under the fractional investment system, they'll be able to buy and sell units within that particular property. So if you wanted to cash out for whatever reason, you could offer your shares up to anyone within that particular syndicate.
At the higher value if it's increased?
Yep, so it'll be valued every year, so we'll know what that's looking like on an annual basis. If you were to sell them, you may want to get it revalued yourself just to see that you are asking the right number. And if you can't find anyone within the syndicate to buy, you can then go outside of the syndicate to sell it.
From a commercial perspective, where do you fit in it and where do you make your money?
So I guess I'm a project manager, for want of a better word, who brings to the table the IP and the knowledge around the rules and regs of these, where to go to get the finance, who you should engage from a property management, and what builders are experienced in these builds, because if you don't get the plans and the build right, you're up for a whole lot of pain. So I work closely with the builders to make sure that we're getting everything done on time and correctly. I derive my income through referral fees, and the clients either take my advice or don't, but I can take them from site selection and purchase through to property management, do all of it for them or do one piece of it. It's up to them.
And then once the property's up, you've done your project management piece, the real estate agent can technically work directly with the investor.
Correct. To
get them obviously filled.
So these are very specialised spaces to have from a property management perspective, and some or many property agents that you speak to, property managers, won't touch them because they perceive them to be too hard.
10 headaches as opposed to one.
Well, in reality, it's like running a small block of units or apartments. I don't see the difference, but they perceive differences. So I do have 3 different agents that I have been working with. We've recently partnered with a group, Certainty Property, out of Sydney, who are breaking into the Victorian market right now, since middle of last year. they have a great understanding of these, and they are actually offering up 75% rental guarantees. So if your rent ever drops below 75% for any reason, whether the tenant's just not paying, whether they can't fill one of these, whatever it might be, they'll top it up to 75%. So you always have that guaranteed stream of income.
It sounds too good to be true from an investment perspective. What's the catch?
Finance. It really is just finance. So that's part of our solution, is that discussions that we've had with Domicom, giving people the opportunity to enter it at whatever level they're comfortable with, and they might want to buy 50 shares, they might want to buy one. It doesn't really matter. And we'll be able to, once we have that ball rolling, they can either take the monies that they're receiving and then start putting it towards another venture, or they can just put it towards a super, whatever they might want to do. And that's the other thing too, with the fractionalised investment system, you're going to be able to use your self-managed super funds, because as you would know with your finance background, that we can't take self-managed super fund and build something. It has to be
personal use.
Yeah. So this is going to get around that issue, because you can't buy a property, knock it down and build it under your self-managed super fund. It has to be a single contract deal, right? So that's going to help with that. And yeah, look, it is getting easier. The banks are starting to understand it. I have a couple of brokers now that have contacts in the right places that I can refer my clients to, and they'll get looked after in the appropriate manner.
Yep. How many projects have you got, projects going on at the moment?
So at the moment, I'm personally involved in 4. One of our major investors is probably ready to, well, they're presenting to the board this week. Once they pull the trigger on that, they could be doing 4 at once, so I could have 8 this time next week, I don't know. But yeah, my job's pretty simple. It's just keeping an eye on everything, making sure the right people are in the right places at the right time, and everyone's doing their side of things, looking after my clients.
Once obviously the project's complete, as I mentioned earlier, you mentioned a yearly review, etc. Is that you're still involved and still managing a piece of the project?
So I don't manage the project as such, but I'm just making sure that the right things are being done by my clients or for my clients. And part of that is obviously getting the valuations done on an annual basis, making sure that the property management side of things are being done in terms of rental increases when required, if required. They do tend to go up every time that they're re-let. The vacancy, occupancy rates sort of sit about 95%. So the one that we're handing over this week, we've already got 6 of the 9 filled, ready to go.
What suburb is that in?
That's in Frankston. And we have a list of people who we had to knock back, because you have to be very selective when you put in people into these places, because it is reasonably confined.
There's 9 different, effectively, personalities coming into one location.
Yeah. Well, we did one for Studio Homes Victoria in Frankston and Stanley Street, and it was August last year. They had 87 applicants in week 1 at $310 per room. So the demand's there. It's just making sure that you get the right people in there.
What's the typical issue when people all come in for the first time? You get 9 people clashing for the first time who don't know each other, most likely. What happens if there's a clash within a week?
Look, the beauty of it is, whilst they are going on normal tenancy agreements, they still fall under the rooming house regs, which means that if there's someone within that environment who is causing issues, it's very easy to have them removed from the property under that law, so that regulation. So, but what we find is they move in. It's like moving into an apartment building. You don't necessarily know more than 2 people on your floor. They come home, they go to their rooms, they have their kitchenette, that's where they eat. They've got their own ensuite, so they're not having to fight over bathrooms in the morning for the showers. We have communal kitchens that we know rarely get used. Christmas time, someone might want to do a roast, but they rarely get used. The main thing that from the communal aspects is the washing machine. Everyone needs to use a washing machine, which
A roster of some sort.
no, first and best dressed, literally. And those are pay machines, so you can either coin operated or pay wave. So it's another stream of income for the owners.
Fantastic. Frank, this is a fascinating type of investment. Thanks for coming on Ticker Property.
Pleasure.